The stock market just hit its 23rd record high this year. Home prices are higher than ever before, and net worth in America has never been larger. By the numbers, this is one of the richest moments in the history of the country. But at the same time, consumer sentiment toward the economy has fallen to its lowest level ever recorded. It's lower than the early 80s recession, lower than the 2008 global financial crisis, and lower than during the pandemic lockdowns. So there's a clear disconnect between what the data says about the economy and what people say they're experiencing in their day-to-day lives. And you can see it up close by looking at the most boring account in America. Because the average 401k in America just hit a record high, over 160,000. And in the same year retirement account balances hit a record high, a record number of people were also cashing them out early, willing to pay the penalty just to get access to the money. About 6% of savers rated their retirement, which is roughly triple the rate before the pandemic. Of those hardship withdrawals, 36% were to avoid foreclosure or eviction, 31% were due to medical expenses, and 13% were to cover tuition-related expenses. So, while on paper we're all living in the same economy, the reality for millions of Americans is the economy feels like completely different worlds, which raises the question, how is this even possible? How can the data show a booming economy while the average person feels the exact opposite? Well, here's what almost nobody will say out loud. Both of these economies are real. The problem is that the American economy looks very different depending on where you stand. Because what we talked about earlier is rising asset prices, and it doesn't lift the country evenly. It's not weather. The trillions of dollars that get created when the market climbs don't fall on everyone like rain. It lands in specific accounts belonging to specific people. And if you don't own those accounts, the record highs aren't really happening to you. They're just a headline you scroll past on the way to your 9-to-5 job. So the real question was never whether the economy is booming. It is. The real question is, who benefits from it? When the market prints another record, whose account does that money actually flow into? And to answer that question, you just have to follow the paper trail. So that's exactly what I did. There are about 134 million households in America. According to the Federal Reserve's own data, the richest 1% of them, around 1.3 million households, own more than half of all the stocks in the country. And if you zoom out to the top 10% of wealthiest households in America, which is about 13 million households, they own roughly 87% of all the stocks, which means the bottom 90% of the country, around 120 million households, own just 13% of the stock market between them. And the further down you go, the worse it gets. The teachers, the nurses, the bus drivers, the people who run the day-to-day of this country, the bottom half of Americans, those 67 million households own just 1% of the stock market. Not 1% each, 1% total, split between all 67 million households. The usual response to this is that almost everyone owns some stocks now. And technically there's some truth to that, because it's estimated about 58% of Americans own some stock, usually inside a 401k. But owning some stocks and owning enough to matter are two very different things. Because for the bottom half of the country, the median stock holdings are about $13,000. But for the top 10%, that number is around $600,000. That's a 48-fold difference. And when you put actual dollar figures to that gap, the scale becomes impossible to ignore. In 2025, the stock market returned about 16%. For the bottom half of the country, that's a paper gain of about $2,000. But for the top 10%, that same 16% return in the market handed them over about $96,000. And this is just 1 year we're looking at. Now consider that the market has risen over 120% since 2020. So, While participation in the market got democratized, the dollars never did. The richest households who own almost all the stocks benefit from almost all the gains, while the bottom half of Americans fight for the scraps. But let's forget about the charts for a second and look at the ground level. Because the story you keep getting told is simple. The consumer is strong, spending is holding up, the economy is fine. And on the surface, it could appear that way. But the truth about the average American consumer isn't in the headline, it's in their wallets. And you have to start with the money coming in. Last month, average hourly earnings were up about 3.6% from a year earlier, which sounds like a raise. Except over that same stretch, inflation was up 3.8%, which means the raise got eaten by inflation before it ever landed. So before the average American spends a single dollar, they're already losing ground. And this is being felt everywhere. Gallup held a survey where they asked Americans to name the single biggest financial problem facing their family. The top answer wasn't low wages, and it wasn't unemployment. It was the cost of living. High cost of living and inflation was named by 31% of Americans as the single most important financial problem facing their family today, which is near the highest level seen in the more than 20 years Gallup has run this survey. And once you remember that prices are up over 28% since the start of 2020, it isn't hard to see why 55% of Americans say their financial situation is getting worse. So, add this all up, and it leads to one question. If the average American's finances look this grim, how is consumer spending still going up? Where's the money coming from? And there's an answer. It's coming from the future, from debt.